If there was ever a time to be taking on risk to look for deep value opportunities of buying precious metals in the ground, I think that opportunity is here today.
Please join us for our next live stream, Sunday, December 5th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, December 5th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you're new to our channel or if you haven't already done so, please do subscribe, hit that bell to be notified, and give us a thumbs up. We really do appreciate these thumbs ups, and thank you for it. Tavi Costa joins us again today. Tavi is a portfolio manager at Crescat Capital and has been with the firm for 6 years. Tavi built Crescat's macro model that identifies the current stage of the U.S. economic cycle through a combination of 16 factors. His research has been featured in the financial publications such as Bloomberg, the Wall Street Journal, CNN, Financial Post, the Globe and Mail, Real Vision, and Reuters. Tavi played NCAA Division I tennis for Liberty University as a side note, and we're delighted to have Tavi join us once again today. It's time to saddle up and silver up for Tavi Costa. Tavi, welcome back to SBTV. How are you doing?
Patrick, thanks for having me. Looking forward to this.
Thanks for being here with us once again. I appreciate the time that you've given. Tavi, I want to start off with a tweet you recently posted. Where are we in the precious metals cycle? Gold and silver stocks have never peaked at historically undervalued levels, and miners are now trading at the cheapest fundamental multiples we have ever seen. Tavi, where are we in the precious metals cycle?
Look, I think it's important to look at the cyclicality of the industry in order to answer that question. The goal here was to really go deep into the numbers of miners in general and understand the valuation profile of those companies and those businesses, along with the historical trends that we see as far as spending money and also the balance sheet changes that we see over time as well. I've never seen the miners, as far as the history goes, when it comes to finding history and data for those businesses to be as cheap as they are today on a free cash flow yield basis. But that's not the only thing. I think the other part of that has to do with the profitability of the industry as a whole. When you look at the entire, let's just call it the top 50 miners in the Canadian and U.S. exchange, those top miners are about 73% of them are actually profitable on a free cash flow basis. That's quite impressive. We haven't seen anything like that before. And that has to do a little bit with the CapEx situation. The CapEx of those companies have been going lower and lower as far as the secular trends that have been declining over time in the last, I would say since 2011. And that will have a lot of implications in regards to the development of new mines, exploration, and all that. And so we think the supply issues of precious metals will be something that may drive also prices much higher. And it's something we usually tend to see quite the opposite. The capex growth tends to be very strong at the peak of the cycle. We're seeing quite the opposite today. Now let's go back to the balance sheet side, which I think it's even more important. The balance sheet side, looking at the net, not only the leverage, I would say, position of those companies are in a form that we haven't seen before either. If the miners were a sector of the economy today in the U.S. economy, it would have the cleanest balance sheets of all the sectors. And we know it's a very capital-intensive business model, and it's quite impressive to have such strong levels of balance sheet as far as total debt to total assets go, as far as a fundamental metric. And so what is going on there? It's not like the miners are swimming in cash. There's also a little bit of, I would say, overstatement of the improvement of this industry, they're not swimming in cash just yet. I think they will very soon, given the profile of the growth in regards to free cash flow. Now, what is happening in a large way is the net issuance of debt, for instance, has been plunging. So they've been paying out debt in a very significant way, using their free cash flow between 60% and 80% sometimes, depending on the company, of free cash flow growth in order to pay down debt. And so the result of that, we're not seeing the same level of equity issuances that we've seen in the past. That is another cyclicality metric that we're seeing today that does not show that we are at late stages. In fact, it shows quite the opposite. That's what we see at the very early stages of a bull market for precious metals and the industry as a whole. And so those are all the important parts. There's another part of it that I didn't touch yet that I think is linked to this, is miners are gun shy in spending money or acquiring other projects and acquiring other businesses just yet. So if we look at the M&A cycle for this industry, it does not compare anywhere close to what we saw back in 2011, in 2010, and so forth. So companies are not leveraging up to buy other companies at unsustainable valuations. We're seeing quite the opposite yet. Maybe that's just getting started. We're seeing some signs of M&A beginning to heat up. But I think we're way too far from what we think we could be in the following years. So apologize for going a little long here, but that's basically the case, the macro case, looking at the whole industry and why we think precious metals are not only a cheap asset to own, but with a lot of growth embedded into this whole business model, but also we think it's going to be the new growth stocks of the next 10 years or so. So we're very excited about this industry.
So would it be right to say that we are still in the beginning of the precious metal cycle?
That's right. And I think if there was ever a time to be taking on risk to look for deep value opportunities of buying precious metals in the ground, I think that opportunity is here today. I think there's very small percentage of capital allocators putting smart capital into the exploration side of the industry. Is a part of the industry that is seen as very speculative, and it is. But if you find the right set of expertise along with statistical work on how to manage money into that space, which is something we've been trying to do by quantifying, systematizing what they call the Lassonde curve of the industry, where you see the appreciation of companies and what is the ultimate value of those businesses when they reach the peak of that exploration phase of the Lassonde curve. We've been trying to work really hard to figure that out on our end, and so we think that there's a lack of alternatives of investments that yield more than inflation today in an investable universe. And so that creates an issue for, I would say, capital allocators that have been not allocating enough money into commodities and other natural resource related industries. And we think that that's going to shift in a large way, especially because the incremental dollar of those large capital allocators almost has to go somewhere else. They have reached two extremes. One going to fixed income, as you can see, interest rates falling for the last 30 years. On the other side, you have the technology industries or sectors and companies on the software space. So just a very interesting metric is just look at CapEx for the tech companies, which are not capital intensive industries. I'm not trying to say that, but just look at the growth profile of those companies in regards to CapEx relative to natural resource industries. You will see a major divergence between the two. You can take oil companies, base metal companies, precious metals companies, agricultural companies. It's really interesting to see that most of the capital has been flying into technology and not looking at basic necessities of the economy. And so we think we're going to see a shift on that in the following years. And ultimately, it's going to drive the value of those exploration companies, developers, producers. The entire industry should benefit. But we think that if there was ever a time to take risk into the smaller part of the industry with deep value opportunities, we think that time is now.
Miners have been described as free flow cash machines. Well, Tavi, having said that, Does this mean that we're going to see more exploration coming from miners? And if not, what is holding miners back from exploration?
Oh, we will. I think we will see more exploration. The issue is that we've seen in the last 20 to 30 years, I think a misallocation of capital into projects that don't have the grade, don't have I don't think they have the economically viability of other projects that could have been perhaps explored or developed over the years. And so I think and maybe the lack of that was, I would say the corporate behavior of companies in the mining space have been, very, I would say, was very aggressive in the 90s and 2000s. And now it's quite the opposite. It's extremely conservative. For them to spend money on the ground for something that doesn't generate free cash flow, it's a problem. You tell me when was the last time Newmont or Barrick developed a new mine? It's a really interesting time that we're in today. But I think, Patrick, we're going to go through a new age of discovery, and we at Crescat Capital want to be financing and funding and investing in the companies that will be the next discoveries. We found some of those, and those are still not actual resources. So it's kind of a sandbagging the new discoveries of gold, which has been dismal, as you all know, for the last 3 to 4 to 5 years. It's been in a declining trend when it comes to the new discoveries of gold and silver worldwide, even copper too. And so we think that, or at least our goal is to invest in world-class potential discoveries and projects worldwide, getting as much as 2 to 20% stake in those companies and really going heavy in helping them to explore aggressively. And so, no, but it's been very challenging, as you know. The political effort against those trends has been very strong, and I think it's what's going to lead to higher prices of metals as a whole. It's very interesting how the demand case and the supply case have never been so strong for commodities. And so, when you have a pullback like we're seeing today in the last few days or so, it's a time to be looking at that market and seeing now how can I allocate capital in this whole space the most intelligent way. That's what we've been doing for the last 3 years. We think it's a major opportunity.
Tavi, you touched on mergers and acquisitions, M&A. And if we go back to 2014, we could recall names like Glencore / Rio Tinto, Barrick / Newmont, and these companies were also talking M&A. Do you think we will see mergers and acquisitions, or at least talks of M&A going on in the mining space today, where the stronger may elect to get even stronger?
I think eventually we will. I think we're still missing that side of the equation, which is where profitability leads to cash accumulation, where we've seen a very long period of capital bleeding into this industry that has caused, and it has cost, balance sheets being very in a very bad stage right now. So we are seeing now a major improvement of those balance sheets, and if that continues for the next 2 to 3 years, those companies will be probably swimming in cash, as I said before. And so that almost has to lead to other more M&A activity at some point. It may lead to dividends, higher dividends too, in order to attract more capital. I think we're entering a macro regime change personally, where cost of capital is starting to rise. And so this whole idea where we have not been focusing on profitability may change significantly from here. And as we see that, I think companies are going to have to use different ways to attract capital from capital allocators, which used to be more focused on growth. If you're growing top line, you're basically attracting a lot of the capital. That's what we've seen. Most of the companies in the software companies, they're very long duration businesses and business models and assets where you're really betting on the future free cash flow of those companies that will be generated. I think that if you look at the mining companies, it's almost like they have a little bit of both. They're not presently also generating a ton of money, but we think they will continue to do so in the following years, even more. I mean, imagine if gold doubles from here, gold prices. Imagine if silver goes to $50 an ounce. It's not too much of a stretch, given the macro and the fundamentals of the environment today relative to where those prices are. It's almost shocking to see silver trading is still below $25 an ounce. And so I think there's quite a lot of opportunities ahead, but I do think we're going to see an M&A cycle, to answer your question again.
Earlier this year, miners were white hot, and since then they have cooled off somewhat. But from what you are seeing, have they cooled off to a point where miners are now oversold? And if so, should investors be taking a look at buying miners?
I think we're setting up very nicely for a strong end of the year rally. But what do I know? I'm not betting on specifically on a short horizon here. We're investing for the real long term here. But if you ask me, as far as the technical trends that we've seen so far in the last weeks or so, since especially Powell renomination here, or nomination to continue in the leadership of the Federal Reserve, I think we saw this pullback that is unwarranted in my view. Yes, gold tends to, gold is what not leads the way, but ultimately is what drives everything. And then you see silver and the miners leading the way to the upside with a much higher volatility embedded into those assets. Now, what we've seen with gold throughout history is that when it hits new highs, it tends to struggle for a bit. Back in 1978, we saw something similar. Gold had its first run in the beginning of the 70s and then went through a tough period. And in 1978, it hit new highs. And for a few next months or weeks or so, gold was down somewhere close to 15%. If you look at the chart today of gold back in those days, it looks like a blip. People don't even remember that. But that's the nature or the degree of the sell-off we've seen today, about 15% since it hitting its highs in August of 2020. Well, back in 2008, we saw gold hitting new highs, which took gold about almost 2 decades or 3 decades, almost 3 decades to actually hit that again. After doing that in the late 70s and early 80s. And after that, we saw gold getting caught up in the global financial crisis, was down somewhere close to 28%. Any technical expert should be telling you at that time, oh, gold is breaking down. You shouldn't be buying gold. That was the exact time for you to be allocating capital in that space, because gold and silver and miners went on a bull market for the next 2 to 3 years. And so I think what we're seeing today is that the same issue, gold is struggling after hitting new highs in August of 2020. It's just resetting its energy to go significantly higher. And I think what's going to lead the way to the upside will be silver, in my view, because of how, if you looked at gold and silver ratio being at the 70s or so, usually taking out the pandemic crisis, which really made this chart of gold and silver, really change quite a lot. But if you remove that part of the chart, you can see that the levels that we are in terms of that ratio, it points to be at the very early stages of a precious metal cycle too. And it also shows that silver is not only cheap relative to equity markets, relative to the monetary base, the money supply, growth that we've seen, the monetary and fiscal disorder, other commodities, right? Because we've seen commodities rising, but silver lagging. But on top of it, you also have silver being relatively cheap when compared to gold. And so I think it is the cheapest metal on earth. I've said it in your channel, in other channels many times before. And it's an incredible time to be finding assets that are linked to that as an opportunity.
You also touched on silver here. It's well known that silver does remain undervalued relative to gold. We see it in the silver to gold ratio. We also see it in what the miners are telling us, with the ratio being 7-1, silver coming out of the ground to gold. And we are seeing silver showing us a double bottom on the charts. Tavi, got to ask you, why is there no love for silver?
Well, I think there's a lot of fears on speculation of the metal, and some of that is definitely some valid points on that. But I think the macro case is significantly bigger than that part of the story, and I think will trump that part of the story in a very large way. I think the other part of that is how gold has been so unloved, and this whole idea that Bitcoin is going to replace gold, which for me is not the right way to look at. I think they can certainly coexist as alternatives of the monetary system in an environment where fiat currencies have no anchor in regards to the value of those assets. And so, it's not about only owning tangible assets, but it's trying to avoid holding fiat currencies in an environment where central banks have lost control of what's happening worldwide in regards to inflation. Now we're seeing three pillars of inflation running at at full cylinders right now, and meaning I think that central banks in general have not a lot of the leadership among developed economies especially have forgotten how to deal with inflation. Japan right now, producer prices index is at an 8% year over year. That's the highest level since the 80s. Japan was supposed to be this economy with aging population problems, and you have money velocity declining secularly as well, and all those issues with deflation. No one is really talking about how inflation is starting to pick up in a place like Japan. At the same time, you look at 10-year yields in Japan, it's at ridiculously low levels. And so at what point we're going to see the reckoning of those imbalances? It's those are all important questions, and it's almost like all those central banks are trapped, because the amount of leverage in the system and the amount of valuations in regards to equity markets and junk bonds and real estate is at levels we haven't seen before. So how do you fight inflation in an environment like today? I mean, Powell today saying that he thinks inflation is a problem and will become a bigger problem perhaps. But let's just call it, they're acknowledging that inflation is a bigger problem than what they thought, and they should not be using the word transitory anymore. Well, look, you don't fight inflation with double-digit twin deficits. On top of it, throwing another $200 to $400 billion of QE and leaving interest rates at zero, and then telling natural resource companies that they cannot explore, develop, and produce those commodities. And so, this is a real problem, and those guys are clueless about the impact of this, in my view. So, no, it doesn't surprise me that silver has been unloved, but I think it will be that inflationary asset that will benefit from this.
Yeah, speaking of central banks trying to fight off inflation, you actually put out a tweet, more like a photo, and you posted a picture of a door latch with a Cheeto instead of a sliding bolt. In your view, can central banks keep inflation at bay?
No, and I think we may see. Well, the reason why central banks are really trapped and hamstrung, in our opinion, has to do with the imbalances in the macro world. And when you look at, as far as overall debt to GDP ratios, the peak inequality problems, this idea that we have to go through a green revolution, which is being driven by a lot of, so there's a lot of political effort, true political effort behind this. And the infrastructure revamp. I mean, just thinking, the amount of checkable deposits holding that households are hoarding today in the banks and so forth. When you think about that, the size of being at 3.6 or so trillion dollars, a level that we haven't seen any other time in history. And on top of it, they're saying, look, in order to fix the inflation problem, we gotta do some infrastructure developments. Well, that just means massive fiscal spending on top of it. So it's, I think, like I said, I think, watch what's happening with emerging markets. They've been basically telling you financial conditions are going to have to tighten a little bit from here. We're way too loose. They're way behind the curve, but at the same time, they can't do much. So, for a gold tangible asset investor, this is the best environment you could ever look for. And so I think even the fiscal impulse, right? I mean, we've seen so far back in since the pandemic started, the fiscal stimulus has been tremendous relative to any other time in history, perhaps unprecedented, depending on the country. And so how do you remove that from the market all of a sudden? You can't do that. The negative impact on the fiscal impulse side of actually going from a massive number to close to zero, really will hurt the economy. And just because we've seen this sugar high growth in the first months of the year and now, at some point, you still need to go back and think, well, is that organic growth or this is just driven by central bank and fiscal policies, which basically are the same thing nowadays? No, there is no independency of central banks like it used to be before, perhaps, and now we don't have that anymore. But again, go back to the emerging markets case. Look at what Brazil is doing. Look at what Brazil has done with their interest rates. They know the inflation issue, and they know how they have to fight an inflation problem and how to take things a little more serious in developed markets. I think that if you looked at as a case, certainly we're seeing interest rates trends of much higher interest rates in those places. And I'm not claiming that Brazil is just doing the right thing relative to developed economies, but they do have a much bigger degree of fear about that as being a problem than developed economies, which in my view are absolutely clueless about how to fight this. And so we've been in this age of disinflationary forces for so long that not only policymakers don't know how to deal with this, but market participants are also clueless. The younger crowds, the people that have not lived through the 70s, the people that didn't live in other places that had inflation, like myself, who lived in Brazil, who saw inflation in the 90s and 2000s too. We've always had those issues. And so there is a lack of understanding of this macro regime change that will change, in my view, per se, the environment quite a lot.
Tavi, I want to touch on gold and inflation. Now, in your analysis, you found that gold actually front ran the potential risk in consumer prices after the lows of the pandemic back in 2020. Can you explain to us this link and if gold is still front running the CPI?
Look, I do think that gold, it's funny how no one was talking about at those times when inflationary gauges such as the CPI, which we think it's massively understating what the real inflation is in the system. I think that when you look at that relative to gold back in the mid parts of 2020, where both are diverging, i.e. the CPI figures were actually decelerating while gold was rising coming out of the recession. It was not really notable at all by other folks. And now we're seeing quite the opposite. After leading the way to the upside, we're seeing gold getting beat up here recently at the same time as inflation is rising. But when you step back and look since the global financial crisis of the growth in CPI relative to gold prices, the link is very close. And ultimately, yes, gold is going to be that inflationary hedge, in my opinion. I don't think this is a new environment where, Bitcoin is going to replace gold and things like that. Look, I think they can both coexist. You think Bitcoin is the fastest horse? Then buy Bitcoin. That's fine. But I do think central banks is still buy gold at the end of the day. And, I think we're going to go through a trend, Patrick, of an improvement, a need for improvements in, I would say, international reserves of countries worldwide, where this crypto move is more than anything, aside from being a huge technological advancement, but also a lot of shifts in that space, which are also with a lot of speculation embedded into that too. But what I think the crypto movement really is a massive libertarian move of a bunch of folks getting together to develop a parallel world and saying we don't want this link with the government anymore. And I think no one is seeing it that way. In my view, it's one of the biggest libertarian moves we've seen in history, in my opinion. And what's going to create from there is the sense of market participants that holding cash, as Ray Dalio likes to say, cash is trash. It truly is. And perhaps the biggest concern for an average investor is to actually be holding cash. So what is going to cause is that central banks are going to be forced to improve or create an anchor or a value, something to anchor the value of those fiat currencies outside of debt. Right? Central banks, it's as crazy as you can think. Back in the 70s, if you would have told anybody back then in the early 70s that central banks would be really supporting their own currencies by buying other countries' debt, meaning U.S. Treasury, in order to create an anchor for their own currencies, that would be insane. But that's precisely what we've seen. We've gone so far in that trend that I think we're going to see a trend back to owning tangible assets, where it's going to drive central banks to look for real value or real tangible assets that can actually create an anchor for their own currency. So I think we're going to see central banks buying gold again. That's going to drive the demand side. But again, there's a supply issue. It's so many. There's so much optionality to own tangible assets nowadays that I think it's one of the most exciting environments we've seen in a long time.
I just want to ask you a question about fiat and in particular the USD, the dollar. It's moved up from 89 and some change earlier this year to now over 96 or so. And it has been doing this in a time of massive printing, inflation, as we've talked about, which leads to devaluation. How is this possible where we are seeing the US dollar getting stronger and rising in this environment?
Well, I think people forget about how this is all a relative game. Doesn't matter if the dollar is appreciating relative to the euro or appreciating relative to the Japanese yen. It's almost like a lack of knowledge, in my view, from a lot of macro thinkers, market participants in general, investors, of what's happening as far as the macro imbalances in European countries or Japan or Australia or Canada. There are a lot of issues in regards to those countries as well. We have macro imbalances in those places that are just as bad as they are in the US. The political environment is just as bad as in those places too. But we tend to forget that a lot of times, that is a relative game. And so does it matter if gold is rising relative to almost every fiat currency worldwide, but perhaps is going up less relative to the dollar? It doesn't really matter. I think the point is that the trend is that fiat currencies are in a race to the bottom, and who wins that race is a good question. I think there's a lot of candidates, and obviously emerging markets tend to lead that race in a big way as far as losing value over time. You look at Brazil lost, in the last 10 years, 8 years out of the 10, the Brazilian real depreciated versus the dollar. Those are all important metrics that people forget. The biggest risk for a person living in an emerging market is to actually own the local currency. And so how do you become a wealthy person in an emerging market with international standards is a question for any person who lives in an emerging market that developed economies don't think about. And so I think that the dollar is still a little bit stronger. We're not betting too strong on that. We're betting more that, for instance, the Chinese yuan or the Hong Kong dollar are extremely overvalued currencies relative to where the recipe for currency and credit bubbles really are. We think that there is the entire case for you to be shorting a currency given where we are in regards to overall debt and the imbalances in a country. That's what you have in China today and Hong Kong. Sure, they have been fighting very strongly for many years. In the case of Japan, of the Hong Kong dollar, many decades. But ultimately, we like to have those as just asymmetric bet. Those are just put options on the CNH and the HKD that don't cost us as much as you would think to get a massive notional exposure in case we do have those recipes for a disaster actually playing out. So I think there's a lot of interesting bets on the FX world. And what drives FX volatility, which we will see more of that in my opinion, has to do with the cost of capital rising, this issue of interest rates. You start looking at negative yielding bonds. Remember when we used to have $17 trillion of negative yielding bonds? We don't have that anymore. Things are changing. Interest rates are starting to rise worldwide, not just in the US. So, I think it's important to keep an eye on the relative game of currencies, because I think the volatility of FX will continue to be higher than it had been in the last 10 years, for instance. So there's going to be a lot of opportunities there as well.
Earlier, you touched on central bank and reserves. And we all know central banks are buying gold. In fact, Singapore is no different. Recently, they've added some 26 tons of gold. First time they've bought gold in some 20 years. They've added to their official reserves. Now, in 2011 or so, or prior to 2011, as the bank's assets grew, the gold price went up, and these two went up in a fairly tight correlation. And this changed a little after 2011, where we saw gold dip as central banks' assets would rise. This tight correlation is no more, and there is a gap that's starting to widen. Why are we seeing this once tight correlation starting to widen?
My 2 cents on this is that I think gold, like any other asset, we should not be trying to figure out what the future price of an asset will be by looking at one or two factors. I think there's a lot of things that play out into what impacts gold. One of the major ones is we've seen since the global financial crisis, we've seen central banks have been progressively increasing what they have done in order to fight recessions and economic downturns worldwide, starting from the 87 crash all the way to the global financial crisis and what we saw recently. But we went to an environment recently where there were a lot of disinflationary forces in worldwide, I would say. Yes, we saw inflation in financial assets. Financial assets valuations and multiples have certainly expanded drastically since the global financial crisis. Everybody knows that. But we didn't see the actual real inflation in the system like we're seeing right now. Such as broad consumer prices increase. Even prior to 2008, because I've seen a lot of people saying the spike in inflation today will be transitory one more time, just like what we saw at the peak of the housing bubble before the global financial crisis, when inflation actually turned into a small percentage but deflation. And when we compare how broad the problem is today relative to back then, which was mostly driven by energy, we have a very different environment right now. We've got forces coming from everything, from a wealth transfer from the government to the people, where the bottom 50% and the entire society of the US is increasing their net worth in a very, very significant way. We're seeing the wages and salaries growth, something we haven't seen since in the last 30 years. That is going to be a big change. And on top of it, we're seeing the move in commodities, which is something we didn't really see back to the times that you were referring to, when we saw the spread between gold and central bank assets. But I think ultimately gold will follow that pattern, because that is the actual anchor that we don't have today. And the more dilution of money we see worldwide, the more you should expect gold prices to follow eventually to those levels. So it's more of a way of looking for the intrinsic value for gold, but not necessarily a timing factor. More timing factors would be perhaps the real rates environment, the change in capital allocation out of very crowded places such as technology and fixed income assets into gold, is the sustainability, not just the high, but sustainability of an inflationary environment is another one as well. The situation of central banks being completely trapped. There are different ways to measure that. The flood of issuance of treasuries to keep up with the fiscal stimulus, and what makes central banks being the buyer of last resort of those securities worldwide. And so so there's quite a lot of ways to think about the metrics that may cause gold prices to increase. Again, we didn't mention something we mentioned in the beginning, the supply side of it as well, which is a big part of it. As miners are not spending money on finding gold and silver and so forth and other base metals, that will have an impact on the supply side of that too.
All right, Tavi Costa, before we wrap up, can you let our listeners know how they can follow you and how they can learn more about Crescat Capital?
Well, first of all, Patrick, thanks for having me. And secondly, I would say they can find me on Twitter at Tavi Costa is my handle. They can find me or work at Crescat Capital is on Crescat.net. We put out a lot of letters, presentations. We do weekly presentations about gold companies that we've been investing on YouTube. If you just type Crescat Capital, you will find us, or Tavi Costa, you will find us. It's every Friday at 2 p.m. Eastern Time. But it was a pleasure to be here to share a little bit of my views. So thanks for having me.
All right. Thank you also, Tavi. Appreciate the time you've given and hope we can do it again soon and have yourself a Merry Christmas.
Thank you.
That was Tavi Costa from Crescat Capital sharing his views on the economy and the precious metals industry. To see more of Tavi's work and learn more about Crescat Capital, please visit their website, www.crescat.net. If you like this video and want to see more of these topics, please do subscribe, hit the bell to be notified, share it, and give us a thumbs up. This helps us to continue what we do for you. Audio-only formats can be found on iTunes and Spotify.